And now we have the extension of the foreign exchange reserve, which are the sovereign wealth funds, and also there is an ad hoc system which can be referred as the foreign exchange swap lines among central banks. So the two last ones, so this one and the next one, are so this one is institutionalized, but it's up to the countries that do you want to employ this or not. And the next one is completely ad hoc without any institutional background. So they are much more customized than the previous one. So there is only for a smaller set of countries. What we can see here. So sovereign wealth funds, practically they are investment funds, or they are funds which are accumulating funds from the government, so they are owned by the government. The investment policy is defined by the government, and usually they are separating this fund from any other funds, but in many cases, if the foreign exchange reserve would go after some level of exceeding some level, then they are just outsourcing this money to sovereign wealth fund. But still, it behaves like a foreign exchange reserve because it still purchases foreign assets, and which means that the foreign asset must be denominated in the foreign currency. So still, the objective is that if we have some reserve for a rainy day, then we should be able to sell it and then use it to stabilize our currency. So doesn't matter which definition we are talking about, still these are not that liquid assets anymore, but they are still available for the government. And that's why it's really hard to standardize sovereign wealth funds, because we can find many different versions, many different forms, and also many different investment policies. But anyway, so they are operating on the capital markets. At the end of the day, they are not wiser, not better than the usual private investors, just they have way more money in many cases. So usually what we can see that the biggest investors on capital markets are the pension funds, because pension funds can accumulate savings for 30 years, 50 years, so they, or at least 40 years. So they are really long-term investors, and also they are collecting a lot of money from a lot of people. But also sovereign wealth funds are also relevant because also they are accumulating capital from countries, and that's why they can be also significant. But still, capital markets are still driven by private investors. Just we can see that there are these huge players on the market. So before the the previous global financial crisis in 2008, at least ECB was publishing this report when they were saying that, okay, if we are looking for potential economies, so which one supposed to or should introduce foreign exchange, sovereign wealth funds, we should look for the excess reserves. So if you are increasing your foreign exchange reserves after some level, then it's quite useless to buy additional US dollar denominated government bonds, which are short run and they are not paying anything for you. So if you are saying that you are exceeding the short-term external debt, or maybe you are completely exceeding your external debt at any maturities, then you should start to buy something which pays much more. So in this case, what we can see in the Chinese or Russian case, that it was absolutely reasonable to form their own sovereign wealth funds. So what we can see that 2000s, and especially the 2010s, was the golden age of forming sovereign wealth funds. First sovereign wealth fund was created in the 50s in Kuwait, in 1953 or 9, doesn't matter, so in the 50s, when the government realized that oil prices are always following a sinus curve. So sometimes we have high oil price, sometimes low oil price. It depends on the supply, it depends on the demand, and usually the demand follows the growth potential or expected growth from the world economy. But it doesn't matter. So within a decade, we are always having a low period when we are finding the local minimum for the oil price, and also usually within the same decade we can find high oil prices. And obviously, the budgetary balance for any commodity exporter economy will depend on this fluctuation. So it's really hard to create stable tax revenues. It's really hard to create any export duty revenue when the price of the underlying commodity is volatile. So that's why first sovereign wealth funds were created. And still today we can see that half of the sovereign wealth funds are related to commodity exporter economies. So in this case, they are imposing export duties on this commodity, on the oil, natural gas, or other commodities, and also if the extraction of this commodity is made by a state-owned enterprise, then revenues, or dividends paid by this state-owned enterprise, it can be also channeled into this sovereign wealth fund, or if it's made by private companies, then the tax revenues on the extraction of this natural resource, it can be also channeled into the sovereign wealth fund. So practically these are acting as a buffer, that they are filling it up if commodity prices are increasing, and then using this money up if the commodity price drops under the threshold, and then they need to stabilize the budget. But the problem is that you cannot use it to diversify the domestic economy. So this is not a tool for domestic diversification. So if you are using this money up to build up, I don't know, petrochemical industry, so in the oil sector, that now you would like to process it and not just use it or export it as crude oil, but maybe you would like to produce plastics, which is higher value, or some other materials, then obviously this would require domestic investment. And in this case, if you are using this money this way, then this will be not considered as part of the sovereign wealth funds anymore. So still it requires, by definition, that it should be used abroad and invested abroad. And if we are checking foreign investments, then we can see that this is a lot of money. So foreign exchange reserves alone are huge. Mostly the Chinese economy is responsible for this growth, but also other emerging and developing economies are also, and also we can see advanced economies as well. Yeah. Highly relevant, but also if you are checking investments and all of the total assets of sovereign wealth funds, then we can see. Oh, I forgot one last thing, that these are in million US dollars, so that's one thing, because both scales are missing, but yeah, million US dollars. So we can see that they have a lot of investment at the end of the day, and they are abroad, they are trying to diversify. So according to, unfortunately, there is not much data about the investment. So mutual funds, private mutual funds, are also not that transparent according to their investment policies. So why sovereign wealth funds should be, but still the small set of academic literature that we can check still suggests that these investments are not efficiently diversified. So their diversification level is still has some kind of volatility. So it's the volatility of the portfolio is not zero, it's bigger because they are still more conservative, that they are buying much more bonds than they're supposed to. They are also buying a lot of shares, but they are much more picky because as they are not wiser than the usual or ordinary investor. For example, in 2006 or 2007, they purchased a lot of US banks. So many sovereign invest funds purchased shares in Lehman Brothers or Merrill Lynch, which defaulted or which were really close to default 2 years later. So since then, they became a bit much more conservative their operations. Or, for example, still then also we can see troubles because Abu Dhabi. So one Gulf countries SVF had made a huge investment. So $100 million was invested into Virgin Galactic in 2010. At that time, it was a great idea. Just since then, Virgin Galactic was split into two companies. So that was Virgin Orbit, which was created as a small sat launcher company, and after 6 launches, it defaulted completely. So all the assets were sold. Virgin Galactic, which is supposed to launch space tourists into space, which is supposed to start above 100 kilometers, but they are just launching under 80 kilometers. So suborbital space tourism is happening there, but also they are not frequently launching, and still the company is publicly listed. But what we can see is that the prices are always dropping, so that was also not the best investment for them. So still we can see some hiccups here and there because still they are buying papers which are overly hyped, and later on, mostly they were able to get rid of it, but there were years when they were more than 10% of shareholders in this company, which was bad. Anyway, so if you are checking the destination regions of investments, then we can see that still what is preferred is the Euro area and United States, but also other advanced economies. So we can say that all this money is flowing into the US markets. Okay, 20%, 30%, nearly 30% is going to the US, but compared to the 60% what we were able to see in the case of foreign exchange reserves, we can see that it's way more diversified in case of targeted economy. And also, if we are checking the region of origin, so where the money is coming from, what we can see here that advanced economies and emerging market economies, practically they are quite similar. So the money is not coming from the Eurozone or not coming from the US. This is for the rest of the world, what we can see. And we can ask the question why, because later we should learn about IMF and the reason why these countries were not, we don't want to rely on IMF, because the IMF absolutely mismanaged crises during the 90s. So that was also a key motivation that they wanted to reduce and remove the exposure towards non-market based crisis mitigation processes. And obviously, if you have your own money and if you can utilize your own investments as a safety backup, or even if you can build your foreign portfolios, then it's much better than just wait for the IMF and do something in that one. So what we can see that this is also a huge extension and enhance the robustness global financial system, because at least we have these players who are buying foreign assets. And luckily, it's not just for the US or the Eurozone market, but we can see that this is channeling in a lot of funds into the advanced economies, but also to the emerging economies. So we can see that this is a nice thing, because this provides additional investments, not just goes to the AAA rated government bonds where all the foreign exchange reserves are lending. If you are checking not the current data but before COVID data, we can see that the top SVFs are related. So the first one is somehow Norwegian pension fund, but it's in the name it's a pension fund, but in practice this one is much more like the sovereign wealth funds, because they are collecting oil revenues. Because they are saying that, okay, current generation who is responsible or related to oil extraction, they should also be happily enjoying the benefits of these investments. So that's why their pension fund is linked to these oil revenues, and that's why oil revenues are invested, but after that this money will be paid out, at least revenues of this capital will be paid out as pensions in the future. So what we can see right now, this is high, but maybe on the long run this will be smaller once they start to use up the capital for pension payments. So pension funds has always this nature. Or if they can grow the capital fast enough, then maybe it will not reach a plateau, but it's still smoother growth in the future. Okay, but after that we have Abu Dhabi, we have Kuwait, and we have Qatar, also in the top 10. But also at the same time we can see China and Singapore and Hong Kong, which are absolutely not commodity exporter economies. And this is related to the mismanagement of the crisis in the late 90s, so the East Asian crisis, because that was a warning sign for any advancing economy that IMF can be useful for things, and also IMF learned a lot from this mismanagement, but it's much better if you have your own reserves. So that's why countries started to form their own. But these countries are manufacturing hubs. So they are not commodity exporters, they are manufacturing goods exporters or manufactured goods exporters, which means that in this case it would be really hard to collect revenues like what we were talking about before. So in their case, most of the revenues are coming from the foreign exchange reserve, literally. So if foreign exchange reserves are reaching a level, then we are just separating it and then outsourcing it to become a sovereign wealth fund. In case of China, this is quite simple because of the current account surplus and the quasi-fixed foreign exchange regime, which we know that it's nowadays is quite tricky, but during the 2000s it was way simpler, so it was fixed against the US dollar, and the excess liquidity could be transformed into, the excess US dollar liquidity which had to be purchased to avoid appreciation could be outsourced into sovereign wealth funds. So right now we can see that there is 1, 2, 3. Hong Kong is also practically mainland China, so 4, and there is another 5, just not in the list, not in the top 5 or top 10, but so there are 5 of them. I don't think that there is a 6th one. But if you are checking the data from last year, we can see that not much change happened. So still we can see Norwegian is the biggest, and after that there is the Chinese investment corporation, the Safe investment company, which is also from China. There is Abu Dhabi, there is Kuwait, there is Saudi Arabia, But after that, we can see Singapore, which now is a big one, but also Hong Kong Monetary Authority investment portfolio is also quite a big one. So we can say that mostly the newer and newer ones were initiated and created, and the list is increasing, not shrinking at all, and also the capital is increasing. Obviously, they can be hidden by stock market crisis situations because the investments are happening on public markets in many cases. Unfortunately, due to lack of data, sometimes we have no idea that are they purchasing private companies or not, because it depends on the reporting and the accuracy of the reporting that what is happening there.